Thrilled to have you all here with us joining today. Can everyone hear me all right? Good, awesome. All right. I know we're going to have a few more people joining, but we can get started. Welcome everyone to How to Start Investing. Chantel, you mentioned you can't hear me. Tim, you mentioned, I know you said you can hear me. Can you guys let me know in the chat? We're all good? See. Okay, I'm seeing that people can hear me. Chantel, if you want to double check your audio real quick, or if you want to join and rejoin, we can let you in really quickly. But yeah, welcome everyone. So excited to have you all here with us. At Mogul, our vision is to unlock the world's greatest potential. We support diverse individuals and organizations to achieve their goals and are so excited to have you joining us today for an insightful presentation from Tim Sekou on how to start investing. Tim Sekou is an entrepreneur at heart who bootstrapped, scaled, and exited his first software company by 28, and now focuses his time mentoring first-time founders and investing in mission-aligned startups, co-hosts transformational retreats for heart-led leaders. After selling his first company, Tim traveled around the world to 16 countries in 12 months, no big deal, to reset in 2019, and in that time began angel investing, as he believes that way is the best way to predict the future, and not only create it, but also invest in it. And Tim and I have, of course, worked together before, so it's so awesome to see a familiar face and have you here with us, Tim, to share some insights, and would love to welcome you, Tim.
Thank you, Chelsea, and honored to be here and share what I know to such a wonderful group of people.
Amazing.
Can I get started?
Yeah, absolutely.
Yeah, awesome. So let me share my screen. Can you all see my screen perfectly? Awesome. All right. So just wanted to preface by saying very grateful for this opportunity to be here and share. I'll be kind of diving into both investing in general, just what I've been taking away from my experience getting started, and have a stronger bent on sharing my experience and learnings from angel investing, because there's so many ways to invest, and where I've been focused a lot on is angel investing, as you heard in my bio. So I'm really excited to share with you guys, and we'll have some Q&A at the end. So definitely please ask anything. So I guess, as every investor always says in the beginning of any presentation, really take these as just, my experience. These aren't, financial recommendations that you have to follow. These are just all my experiences that I've learned along the way that I hope will be helpful. Maybe a takeaway from that point is, I've been just researching and studying a lot about personal finance and investing in general. And I take what I resonate with and I apply my own perspective on it. So I hope that's helpful in that, you'll hear from my perspective and my learnings, and then take it in your way that will be most fruitful for your investment adventures. So a little bit about me. I made around 7 angel investments in the last 2 years. And in that time frame, I've also been just mentoring first-time founders, mostly around software, but also all of the different types of industries. I've been able to work with around 30 of them so far. So I've been able to see a lot of different types of companies and make proper assessments on that. I also did do my own company right out of college. I started a marketing software company and I bootstrapped it for about 7 years and sold it in 2018. And ever since then, started my angel investing career. And then I'm just about to start my exploration with real estate and crypto. So like I said, I'll touch on a whole variety of investing, but I'm going to dive a lot more deeper into angel investing, as that's been my own experience. And I think another preface is just saying that, I've been doing this for the last 2 years, and I think I have a unique perspective to be able to share on getting started. So if you guys haven't gotten started and you guys really want to take that leap of faith and see how that can be done, this is what I wanted to share with you guys today. And I think as I'm continually learning, as I'm a forever student in the investing world, I think the best way to learn is to share and teach with you guys. So that's what I'm most excited about for today. So I think when we think about starting to invest, I always try to answer the question, why? Why should we invest? Why should we even start looking at that? And on the left here is a chart of your M2 money stock. Sorry, is your M2 money stock. And what that means is all the money in our savings, checkings, and cash in the US monetary system. And I think less than focusing on that, but more so just taking away that more than $3 trillion was printed and created last year in 2020 alone. A lot of that was from the stimulus package that you guys saw in the bailouts. And that money is directly being sent to us through our stimulus checks or bailouts directly to businesses that get paid to employees, et cetera, et cetera. But lots of money was printed last year. And actually, it was around 20% of all existing US dollars since what, many years has been created just last year. So, there's a lot of question about inflation coming and everything like that. There's a lot of speculation, and all that is going to be, managed by the Federal Reserve and the government. But I think one thing to notice is that if you guys don't know, the US dollar was taken off the gold standard in the 70s. And so what that means is the Fed can continually just print money for their debt and continually rise into the debt. I think I saw an article on Forbes that said that there's a prediction that the US debt will get up to about $75 trillion in the next 10 years. So takeaway is lots of money is being printed, and there's a lot of investors looking at other alternative assets that allow us to hedge against possible inflation. Or in other words, the more you're saving in your savings account, in your bank account right now, the more the money is actually, the value of the money is going to be diminished. Because with more money being printed, that means it's going to cost more money to buy the certain things that we always are used to. And so this is why investors are looking at other alternative assets to hedge against possible inflation. I'm not saying, I'm not predicting any certain type of inflation, but just from a philosophical standpoint. The next chart is on your right-hand side, and this is a graphic from a popular author called Robert Kiyosaki, who wrote the book Rich Dad, Poor Dad. This is coming from his second book called The Cash Flow Quadrant. And the takeaway here is that there's 4 different ways to, quote, make money. And a lot of us are pretty used to either employee or self-employed, where our time, the amount of time we put in is the amount of money that we get back. And so if you think about it, we're capped by how much money we can receive based on how much time we put in. And that's just the nature of being an employee or self-employed. On the right-hand side, you have your business owner, where your employees or the type of business you're in is what leads to more income or more cash coming in. It doesn't depend on your time. It depends on your employees and the automation that you can set up that will create that money in abundance. The last quadrant, bottom right-hand side, is where we're focusing on here, which is you're not relying on time, you're not relying on employees, but you're relying on the money that you're putting in for it to work for you to generate more cash and income, right? So it's a whole different perspective of how we think about generating income. Instead of using our time and our employees, we're using our money to work for us. And that's why what Robert Kiyosaki says, that you really want to be on that bottom right quadrant in the investor quadrant to generate more and more wealth, to the point where your assets that are making you money will exceed your monthly expenses. And that's when you have hit financial wealth, because you're not beholden to try to make money with your time to hit your certain monthly expenses anymore. So those are 2 charts I just wanted to give you of like what I've learned in my philosophies of like why I'm starting to invest. And even a deeper layer of that for me on the bottom here is that I invest because I want to create wealth for my next generation of my family. That's what I see one of my bigger purposes in making my money work for me, not only to live an abundant life for myself and my partner, but also to be able to create that wealth for my next family. And I think that's just a great consideration for you to contemplate with as you think about investing. And I'll add that, they say that money is not the root of all evil. The love of money is the root of all evil. So sure, we can invest and get more money, but I think if we can attach it to a bigger purpose greater than ourselves, I think that will help us find more excitement and passion in investing. So you might be thinking, okay, what are ways to invest? And I just give you a very, very brief overview of ways to kind of think about investing. You obviously have your commodities, which is like gold and silver, and then you have your crypto like Bitcoin that you're hearing a lot right now. And a lot of people are saying that crypto is sort of, or Bitcoin is sort of like your digital gold. So those are kind of your commodity asset classes. You have your typical real estate asset class, which is going out there, buying real estate and ideally not necessarily living in there, but putting it out on for rent on Airbnb or getting long-term resident holders to actually use that as an asset that brings in money, not necessarily puts out money. Robert Kiyosaki says it really well, where the difference between asset and liabilities is that the asset brings in money, liabilities take out money. So how a home like a real estate can be an asset if you're not just paying the mortgage yourself living in there. That becomes a liability. It becomes an asset when you are renting it out and you're actually using that income to pay off your mortgage if you have a loan worth that, and that becomes an asset that you're generating income with. And then lastly, you have your stocks and bonds. You can play in the stock market like Robinhood. You can also then explore angel investing, which is more early stage companies, which is where I focus a lot of my time on, which I'll share most of the presentation about, and then we'll talk about some of the learnings in general. I think the other thing to consider is the pros and cons when it comes to which asset class you're looking at exploring. Right? You can explore all these types, you can diversify. The things to consider is, one is ultimately what your financial goals are so that you understand what the return multiples can be for each of these asset classes. Traditionally, for example, stocks in the stock market traditionally appreciate around 7 to 9% every year. Whereas if you had like a high yield interest savings account, that's only like, it was 2% before, but now it's at like 0.5%. So again, you got to think about multiples in terms of how the money can work for you and how much that can bring back. The other one is liquidity, right? So how liquid is it? How soon can you pull out in cash if you needed to use that for whatever reason? If you lost your job and you needed the money, then how liquid is that? For example, crypto and even like the stock market is quite liquid because you can trade that and sell off your assets very quickly. So that's very nice. But angel investing is not liquid. So you put in that money, you're not going to be able to touch it because it's going to be used by a company. So you have to look at liquidity. Another one is sort of like what I call knowledge contribution. So I always think about where do you want to play that you have just a slight advantage of knowledge in. So you want to spend more time in stocks and bonds, like play in that world, go for it. For me, it's been angel investing because of my past experience as an entrepreneur. So I can speak that language, I can understand how to assess a company. So what knowledge contribution can you give to which asset class? The other one is obviously market fluctuations. Typically, I mean, the easiest way to say this is you see it in crypto with Bitcoin right now. It's just super volatile because it's so new and everyone is looking at Bitcoin as a digital gold to hedge against the inflation. So it's just super volatile right now, but you got to think about market fluctuations and volatility because emotions will come into play when you are into that. And then other ones, although obviously there's a lot of other pros and cons, but just one that references to our presentation today is accreditation and non-accreditation. So what that means is if you wanted to angel invest like myself, you got to look at becoming an accredited investor. And what that means is either you've earned income of more than $200,000 or $300,000 together with a spouse in the last 2 years. You have a net worth over $1 million, or you're part of a large entity that exceeds 5 million, or you're in an entity that has all accredited investors. Now, there is no test. There is no, the SEC is going to come hounding you if you're not and you angel invested. What this is meant to do is that it's a rule that's meant to prove that you as an investor, if you step into this world, have the sophistication and the means to invest in risky investments as well as, weather any losses. So they are pegging, the average knowledge IQ of investing in terms of income and net worth and assets. That being said, there is no test that they're going to audit you for. Usually it's the responsibility of a company that you're going to be investing in or angel investing in that will just check in, make sure you are an accredited investor as well. So how do we get started with angel investing? I boiled it down to 5 different steps here that I'll kind of dive deeper into each of these. So number 1, understanding the game. Number 2, understanding your numbers. Number 3, defining your investment thesis, create your deal flow, and then obviously refining your assessment process. So what do I mean by understanding the game? So I think of angel investing as a game. I think of it like, if I put in this money, what expectation or understanding could I receive, or knowledge that can I apply that will get me to this much money back? And I put a real life example of a different investor that I've read through and I follow, of his last 1, 2, 3, 4, let's say 10 companies. And on the second column, it's how much he invested. The third column is the value of the companies now that he, from what he invested to what the value of the multiple is right now. And then the last column is the actual multiple. So 70,000, company A, he invested 70,000. The company is now worth 1.08 million. And that was a 15x multiple. What I want you to take away from this is, what do I mean by understanding the game? It's that, you'll hear this concept talked a lot about in the angel investing and VC investing world, called the power law. And the power law basically means that these returns that you're expecting or wanting are highly skewed towards a small number of big winners, or essentially a small number of companies that will drive all the returns of your portfolio. So let's dive into what that means. If you look at Company A's return is about 65% of your portfolio return here. So if you look at the current totals on the last slide here, you see in general, there's an 8x return of investing 200K to get 1.6 back. There's about an 8x return. But you can see some of them, Company I lost all the money. Company H only got a 1x return, so there was no return here. And usually that's not the best thing, because there's also inflation, so you're losing money in essence. So what the power law states is that you got to think about investing in multiple companies so that you have a shot at finding one that will bring all the returns, or majority of the returns of what you invested in. So you can see here again, Company A put in 70K, it got a 15x multiple, but overall in that whole portfolio, it represents 65% of that return. So that's what the power law states. And the way to think of the takeaway here is that if you're going to start out angel investing, what I've done is think about, dedicating a certain net allocation of my net worth to angel investing, and I'll go into that a little bit more later. Divide that by 25 companies. And then how much of that money can I afford for each company? And I stick to that, and I stick to that game plan. Because what that means is that ideally one of them will hit, a certain big multiple that will, even if all the other one fails, I'll have returned my money and a little bit more, or a lot more, depending on how that went, and make up for all the losses that if the other 24 companies didn't hit it. And so there's a little good quote here that risk comes from not knowing what you're doing. So that's why I want you to understand what the game looks like in terms of the power law, so that you understand how to approach this so that you diminish your risk as much as possible. The second one is understanding your number. So remember I mentioned that you got to figure out how much money you can invest in each of these companies to actually play the power law to your advantage. So here's a model that I've used, and you can look at the top right corner, launch.co/model, if you want to actually download it yourself for free, and you can play around with it yourself. But the point is, you can change up, what your net worth is, and you can say whatever that number is. You can say what net worth you want to invest in angel investment companies. So for example, if my net worth was 10 million and I wanted to invest 10% of that, that means I have $1 million to play with. And in that $1 million, I want to work with 25 companies, or I want to invest in 25 companies. That means I have a maximum of $33,333 to invest in each of these companies. So maybe I'll just say on average, I'll put 25K or 20 to 25K checks in these. Now you might be thinking that's not where I'm at, and that's totally fine. Just change the numbers to what may work for you. And look, even if you invest in $1,000, $2,000, or even $5,000 checks, that's totally fine. And that's one of the big things I want you to take away with, which is it's okay to start small. You don't have to think about you having to be a multimillionaire to start angel investing. Even if your net worth is in the hundreds of thousands of dollars, and you want to put in 20 to 25 companies, maybe it only means you can only put in $1,000 or $2,000 checks. And that's okay. It's best to get started by starting small, and then just keep playing the game so that you understand the rules and you understand the guidelines to get better and better. some things that I follow is that I usually think about 10% of my net assets in angel investing as an asset class. And that's because angel investing is just inherently more risky than the stock market or traditional real estate. So I think about 10% of my net assets into angel investing, and then the other 90% into all other types of investing. And there's a study from the First Republic Bank that said that if you invest in 99 companies, what they've seen historically is that there's a greater than 75% chance you'll find a unicorn, and unicorn means $1 billion company in your portfolio. And again, it doesn't mean it's guaranteed. It's just saying that historically, when they've run analysis, they're able to see a greater than 75% chance in one of those 99 companies will become a quote Facebook, but not saying you're going to find the Facebook or you guarantee to find a Facebook, but that's the, again, power law being applied here. And that's why you can see the scenario returns are telling you that there's a very small chance that you might get there's a 4% chance, and you can change these up however way you think about risk analysis. But in this case, there's a 4% chance to get 1,000x return. And even if you put in, that 33,333, you're about to get, you would get a $33 million return if you got a 1,000x return. And so you can see how this model starts to play in your favor, and you think about how you can use the power law to your advantage. The next point is defining your investment thesis. So I think this is very important because, look, there's going to be so many types of companies out there. And once you step into this world, even though you don't realize how many companies are out there looking for funding, there will be a lot coming your way if you start to position yourself, and I'll show you how afterwards. But one thing I did really quickly when I first started angel investing is defining my investment thesis. So what that means is you can do it by your values, by industries, by problems, by stage of the company, et cetera, et cetera. So for example, for me, what I've been focused on is actually in the planet sustainability solution. So that's like a value that I very much hold near and dear to my heart, that I want to support companies that genuinely care about the sustainability of our planet and how they're approaching certain problems. So that's led into like a bamboo toilet paper company, or that's led to a plant-based fast food chain. So like I'm thinking about sustainability solutions. Another industry that I've focused on, that's just my own perspective, is actually in the psychedelic industry. That's really up and coming, but I've been in that world for quite a few years now. And so I can use my knowledge to play into that industry. Another example is I typically look at earlier stages of the company. So angel investing is typically like pre-revenue or just starting out. So that's another stage of company. Founders traits could be by gender. You see a lot of women-led funds coming out. You've seen a lot of also by ethnic race to help support the people of color and underrepresented communities. You can also look at unit economics. So what that means is, I'm part of another group that just looks at, how much revenue you're at, or how much you've proven out with your traction. So there's so many ways to approach an investment thesis. These are just a few examples. And I always kind of think about it in this perspective of what's your edge, right? So if you kind of take a step back and realize, what do you just are obsessed about or just so enjoying when you look at companies, that might be a key indicator of how you can hone in your investment thesis. And again, for me, it's been a lot about, like, I naturally enjoy talking about how we can protect our planet more. So that's my edge. And I'm always talking about that. I'm always reading about that. I'm always studying about that. And so I can use that to my advantage when I'm thinking about who I want to invest in. The fourth point is creating deal flow. So let's say you created your investment thesis and you're like, okay, how do I find companies? So there's three ways I think about it. One is your own personal deal flow. So for me, like I mentioned, I also mentor a bunch of first-time founders. And so does that lead to some initial deal flow? Yes, right? Because if they are starting to work on their companies and I'm mentoring them and they get some traction and they're actually looking to raise, I can jump into that deal flow, right? And another way to think about it is just branding yourself. So if you have a website, put like, I'm stepping into angel investing, please email me. If you have any deals coming in on your LinkedIn, you can say, I'm an angel investor. Even if you're putting in $1,000 or $2,000 checks, that's okay. What you're doing is you're saying, I'm putting money into companies that I believe in and I want to support, right? So again, personal deal flow means you can mentor companies and start just supporting them in any way possible, or branding yourself as well. Another way is syndicates. Syndicates are another way to approach angel investing without having to do it all yourself. So typically some companies will be like, I only want people who are going to put in 50,000 or 100,000 or more. And you're like, look, I can't put in that much money. It's just too much of my net worth. So I want to group up with a group of individuals that will all put in, 50 people putting in $2,000 checks. So in aggregate, we'll have a $100,000 allocation for your company, and we're going to go in all together. What that does is it diminishes a lot of risk, because now you have an army coming in together to support you on this deal. And you have an army of resources to help the founder be more successful. And where you can find a lot of syndicates is on AngelList. So I recommend taking a look at that. And the last one, which a lot of, let's say, new investors start looking at, is equity crowdfunding. So what that means is, maybe an easy way to explain it is, if you all think about Kickstarter, where we think about putting money in to get like a reward out. But instead, this is called equity crowdfunding, where you put in some money and you get some equity into the company. And so you all are coming into crowdfund like a Kickstarter, but instead of getting rewards or the product in return, you're actually getting equity, or equity and the product as well, depending on the company that how they position it. And so you can look at these three that are pretty popular in the equity crowdfunding. Typically, it's actually a very easy way to get started with angel investing. You can look at their videos, their risks, their team, their product, everything like that, and their traction. And you can put in $500, you can put in $1,000. And like I said, it's okay starting small, because I think as you start and just put some money down is when you'll start to learn the most. And last, refining your assessment process. So this will continually evolve. How I think about it when I first look at companies is the following 5. First one is the vision. Asking yourself, instead of thinking very pessimistically like, oh, there's too much risk, so blah, blah, blah. Ask yourself the question, what happens if everything goes right with this company? What does that vision look like? What does the world turn into? Does that get you excited? I think that's a good key question to ask yourself and the founder, whoever you're assessing. The next one is the team and the founders. I think about it instead of like, their credentials definitely help. If they've been a previous entrepreneur, helps. If they come from certain backgrounds, it might help give you some indication. But the biggest thing I look for is the figure it out muscle. And what that means is, look, at the end of the day, it's all about execution in today's world of startups. And ideas are a dime a dozen. And so you got to think about, have they figured it out in terms of some traction? Say proven out certain things, they've been able to get some revenue, they've been able to bring the right team to execute on the vision, but how have they figured it out, and assess on that. The other one is the total addressable market. And usually you'll see the billions of dollars in addressable market. And I think the only thing to really pay attention here is that, is it big enough so that this company can get some share of that addressable market, that you would say like, the valuation from what you're raising at to get to a certain amount would make it worth it for your investing to apply the power law. So for example, if you want to put in a company like $5,000 in a company that is valuing themselves at 5 million, but they're addressing a market that is 50 billion, and they can get to 5 billion. In that total, like you think that they have a chance to get to the 5 billion valuation. And we can talk about valuation later, but you can think that they can get there. You look at, that's like 100 or 1,000x, I can't figure it on top of my mind. You're thinking about that perspective, because if that's the case and they can get there, you can apply the power law in your favor again. The fourth one is traction. So this is again tied to number 2, the figure it out muscle. Like, have they been able to execute, or are they just there talking about it and it's just a napkin idea? Obviously, the more traction they have, the more risk that they have diminished to prove that they have something worthy to raise money on. And then the last one is, what are the current alternatives to that company that either you can address as competitors or worthy rivals, or just fundamentally different ways of approaching it, right? So maybe an example is like Tesla. Like when you think about Tesla, you're like, wow, there's such unique differentiation, but the current alternatives is like your Fords and General Motors and Toyotas of the world. Do they have an edge on top of that? And that's how you think about the unique differentiation that they might have, and how do they stack up against the current alternatives right now? And you see that they have a way of branching out of that. So last thing before I go into the summary here is, if you don't have funds or you don't have the accreditation, doesn't mean you can't play this game. All it means is you approach it differently. So how I think about it is, you just start reaching out to founders or people who are starting companies and be like, hey, I want to help you and mentor or advise you, maybe for some equity that, you can say, like, if you are a VP of marketing at this company, you'll be like, I can help you with marketing. Like, let me help you with that. Or you're a VP of sales and I can help you with sales. Or you're a VP of recruiting and you're like, I can help you find really good people on your team. That's how you think about getting involved, not necessarily angel investing with your funds, but let's say angel investing with your time and your expertise. The other way is to pass deal flow and request for, let's call it an intro percentage. So what that means is if you're starting to mentor people, you're positioning yourself as a person who can help mentor or advise companies. And people are like, look, I don't need the mentorship, but I need to, find money from investors. And you just so happen to know people that have funds, or you start getting to know people who have funds. And that is very much in your control of finding. You can say, hey, can I strike a deal with you maybe as a family office, maybe it's a VC fund, and you're going to say, like, can I get some percentage of the profit if they exit because I can get you deal flow. VCs and family funds and all these big companies want deal flow, and if you can get them access deal flow, they might put you on the cap table, or they might give you some percentage, or they're most likely just going to give you a percentage of the profit if they sell. And so I think it's still worth it, and it gets you started. I think if there's any slide that you want to screenshot, it's this one. This is what I've really taken away from my time investing. One is just learn by doing consistently. I think there's what I've noticed in my 2 years of investing is that there's a hesitation to take that leap of faith just in the beginning. And it's very hard to sometimes make that big transfer from your bank account to a company or to something else. And so you can start small, and the key is just be consistent. Do it every year, do it once a month. Think about just some consistency that allows you to start learning. Another one is don't FOMO invest. So it's a hard one to follow sometimes, especially just starting out. But I think the takeaway is that there is always going to be a new opportunity in the future that will be just as profitable as some of the best ones you see today, right? I think a lot of people, maybe crypto and Bitcoin is a great example. You're seeing everyone going in, you're like, oh my God, I'm not going in, I have FOMO right now. And typically that might be an indicator that it's too late. And that might be an indicator to think about where else you can invest your money. And that takes some research, that takes some knowledge, understanding of industries that you're curious about to find a company that is maybe undervalued, that can be betted on, that will have a higher return. The next one is making your money invisible. So what that means is a philosophy that I've been following, even though I have, financial abundance, like I live way below my means and I just invest the rest into cash generating assets. Like I mentioned, real estate, like I mentioned, crypto for the long term, like I mentioned, the stock market. Invest the rest, live below your means, and just make that money invisible. Because what that will do is that you'll be like, psychologically, what that could do, which I think is helpful, is that you'll be like, oh, all this money is just untouchable because it's just going to make me money. It's going to work for itself. And I only have this much money left. And usually you want to keep a 3 to 6 month expense fund at all times in your savings account, just in case anything, challenging happens. And then what that does is that just makes you want to work a little bit harder in your job to make sure you can keep up your income. So you just ignore the money that you do have that's working on itself. Number 4 is joining and investing with the group or syndicate. Like I mentioned, as another way to create deal flow, it just reduces risk by leaning on others and their knowledge and having conversations with them about how they think about certain companies or how they think about certain asset classes. The 5th one is invest only what you're willing to lose. And I always say this very, very loudly because especially in angel investing, there's a greater than 90% chance that the company is going to fail. And if that fails, which is very likely, you'll be okay not making anything back. So that's why if $20,000 checks is too high to possibly lose it all, start with $1,000 or $2,000 checks. And if you're like, oh, it's okay if I lose that, that's a pretty good indicator of where you can start and invest only what you're willing to lose. The next one is something that I'm still adopting and getting much better at, but time in the market is better and greater than timing the market. And I love this quote from Warren Buffett, that the stock market, in this case, that asset class, is the device for transferring money from the impatient to the patient. because usually we have a lot of emotions tied to our money that's getting lost in the stock market, as an example. And so we'll try to panic sell. And instead of panic selling, remembering and actually studying the history of markets, that if you just wait in a longer period of time, it's going to be multiple years. It could be, maybe 10, 15 years. There's historical analysis that the stock market will always recover after a huge dip. And do that research. I have a YouTube channel that I follow that I'll share at the end of this, there's a video I just watched a couple days ago that talks about this as well. Number 7, invest by knowing your edge and diligence. So kind of tying to number 2, don't just FOMO invest because everyone, your mother and your grandmothers are investing into whatever is happening. Invest with your knowledge and your diligence and what the edge is of what you're obsessed learning about, because that will play to your favor. Another one that's super easy to start practicing is dollar cost averaging. And what that means is, let's say, like for me, I'm practicing dollar cost averaging as I'm stepping into the crypto world. I'm looking at it from a very long-term play, not from a swing trading play. Dollar cost averaging just means that you're going to put a fixed amount for a very repeatable period of time. So for example, I might put $500 every week into Bitcoin for the next 2 years. And so that just dollar cost averages out. And what that will do is, instead of trying to time the market and seeing when the dip is and then trying to buy in there and getting stressed out, and then when it's too high, you're like, I'm not going to buy in, all of that. There has been many studies that shown that as long as you dollar cost average by saying, I'm going to put a fixed amount in a very repeatable period of time for a period of length of time, typically you will come out on top by trying to time the market. And again, there's videos on this on YouTube to show analysis of that. And they've shown it with Bitcoin's big swings. They've shown it with the stock market. So try to consider dollar cost averaging. Last thing, just keep staying curious, keep learning and refine. Like, that's the biggest thing I always tell myself. Like, every day I'm learning something new. Every day I'm like seeing a new asset class. Just the other day, I was like, wow, you can invest in wine as an asset class. And I'm like, whoa, that's super interesting. Like, there's just so many things out there that I think it's just best to keep learning. So if you want to take a screenshot of this, these are the resources I have leveraged a lot that it's been super helpful for me to just understand how to get started. And there's books, YouTube channels, podcasts, blogs, and even a program to explore. And this is me. This is my website, my LinkedIn, my email if you want to connect and chat more. I'm happy to support here. So that's it from me.
Amazing. I'm going to clap in this virtual room because that was incredible, Tim.
Thank you.
And I see some thank yous in the chat. A question is, will you be able to share these slides?
Yes.
Yeah, we can make that work. Absolutely. And then I would love to open up some questions for Tim. I'm sure that there is a ton of them, even though this presentation was so thorough, as I see mentioned in the chat as well. But would love to open the question portion up. So feel free, if you'd like to unmute yourself, you can, and ask your question directly to Tim, or you can use the raise your hand feature in Zoom. Any questions?
I actually have a question.
All right. Yeah, go for it.
Jessica, can you hear me?
Yeah, absolutely.
Okay. Thank you so much for doing this, Tim. This is great.
Great.
So I don't have a lot to invest, and I do have some savings, but I'm just wondering what your advice is for someone. I'm an artist, so my money ebbs and flows, and so I'm trying to figure out a way to give myself some passive income. I've been thinking about the real estate thing. But what advice would you give to somebody who, I mean, I guess I'm technically like a starving artist right now.
Sure.
I have faith that I can build some equity in some.
Good.
So creative solutions, I guess.
Yeah. So the first thing is always, consider keeping a 3 to 6 month savings in your savings account, just in case anything crazy happens, right? Like all shit hits the fan and we go into a lockdown again, you lose all job opportunities. It's just a good safety net, realistically speaking. And then the next thing is, how liquid do you want your investments to be? And so do you want this to be a cash flow thing, or do you want this to be a bigger kind of exit opportunity where it brings multiple of money? And or can you leave a certain chunk of it aside for the next 5 years for it to work for itself, or do you need it back a certain time, right? So that is going to help define which asset class to look into. And I think real estate is always going to be something that traditionally has shown to work really well. I think there's a resource that personally I have started to look into. It's a company called Doorvest, DOORVEST.com, where you can start to passively invest in real estate. So what they'll do is they'll understand your financial goals. They'll understand what your liquid returns are, and they'll look for the home. They start in the Houston market. They're going to look for a tenant for the first year guaranteed. And so you can start to build equity and cash flow for a home in the Houston market because they've been able to understand that market really well. I've personally angel invested in them. I'm going to be a customer of theirs as a real estate investor as well. So real estate is typically a good one to start out with. I think the only downside is that you need to consider what a down payment will look like, usually anywhere from a 5% to 20% down payment. But the good thing is that their homes that they look at in the Houston market are typically in the 150K to 200K range. And so that's a really easy way to step into the real estate market without super expensive real estate and be able to start getting your hands dirty with getting cash flow coming in from the rental income and building equity as your home starts to appreciate more and more. So that's one thing I would look at. And then if you want to spend a little bit of time outside of your art or creative artistry, you can explore the stock market, maybe playing with Robinhood for a little bit. I would just say, again, put in money where you're okay to lose. If you just lost it, it's okay. And just start out small. Even if it's like $500 in Robinhood and you're only putting like $10 in a company in Apple, that's okay. What you're doing is you're teaching your mind and your brain how to look at these numbers, how to assess, how to like make decisions, and then you'll just start to refine from there.
Awesome. Thank you so much. That's
You're
really
welcome.
helpful.
You're welcome.
Amazing. Opening up for another question for Tim. Question. I'll just double check here. Oh, I have a question here in the chat. For the different types of investments you explain, are there any that have more of a set timeline in terms of yielding a return to mitigate risk?
Are there any that you have set timeline? Can you ask that in a different way, Jordan? Not understanding it.
Yeah. So if you're making an investment, for the types of investments that you walk through, so you went through stocks, savings,
Yeah.
investing, what have you. I guess what I'm asking, is there one that's safer in terms of putting your money in while still yielding a higher return, as opposed to just throwing all my money in a savings account?
Yeah. So the way to think about it, so just FYI, high interest yield savings accounts are at an all-time low. They're like 0.5% now. Usually it was at 2 or even 2.5%. So that's not going to work as well anymore. What I've been looking at is, I think there's two ways to approach it that come to the top of my mind. One is in the stock market, especially, like you can think about what they call blue chip high yield dividend stocks. So you're kind of like, I think like GMs of the world, these old companies that are very established, but can pay dividends and appreciate in value. That's one that I'm going to start to look into. It's pretty safe, and maybe it won't yield the return of a GameStop per se, but it will be much safer in terms of just getting started. And then another one I just started looking into is the high interest crypto savings accounts. So there's ones called Voyager and BlockFi that I started looking at. So what it does is that, think of it like a high interest savings account, but with crypto. So you can convert your money into crypto and they will pay you a high savings interest rate, higher than your traditional banks. And that's because one of them is public, Voyager is public, BlockFi is still private, but their revenue model is that they're going to take your assets and give out loans for people and use your assets as a way to put out those loans, and they have a higher interest rates for putting out those loans. And then because they can return that, they will pay you a higher interest rate. So that's actually another one that I've been looking at. Again, think of it like a high interest savings account, but with crypto. I know Voyager is FDIC insured. So it's about 250K FDIC insured. So that's actually a very safe way to explore. And it does pay higher interest rates than your typical high interest savings accounts.
Got it. Thank you very much for answering that. I really appreciate it.
You're most welcome.
Amazing questions so far. Do we have any additional questions for Tim?
And maybe I can offer that if anyone is feeling like what's stopping them from investing, I'm happy to hear that and share any thoughts that I've gone through. I'm sure I've gone through a lot of what you've been thinking through to finally take that leap of faith. So if you find yourself just like, I can't take that leap of faith, I'm like struggling, feel free to share that as well. And I can share any thoughts that I've applied that may be helpful.
Thanks so much for this, Tim and Chelsea. This is super supportive. I went to NYU for grad school, and now I have a lot of student loans, but I want to get into investing and crypto. And I'm also a startup founder, so I'm always around other founders and early stage companies, and I really want to be able to support, but I'm wondering how I can start, keeping in mind that I have like 155 G's worth
That's
of
a very good question. So one thing I didn't talk about, which I can just say right now, is that you really want to understand smart debt versus not so good debt. And unfortunately, educational loans is not the best debt because there's nothing in your tax returns that you can use. There is a little bit, but there's not as much as like real estate debt. So knowing that you have student loans and knowing that you want to step into investing and knowing that you have, you're starting your startup world, what I would do is allocate every month a certain amount to start paying off your loans, because it's just going to keep adding up, right? So you want to do everything you can to bring that down, because it's not adding in your favor, especially for write-offs that you can have in traditional real estate loans that are what they call smart debt. So what I would do is allocate a certain amount. I don't know what that amount is. I paid off all my student debt, but be smart in just saying, I want to pay off X percentage every month. So I'm going to put that money in there. And I would prioritize paying off your student loan first, because again, it's just going to keep adding up and accruing interest first. And then whatever remaining you have that you can live below your means. And I think this is a time to really think about living below your means. Investing the rest of that, again, into a stock market or crypto or however way you want to play, will be very helpful. So that's just what I think, like allocate, greater percentage in your monthly income to paying off your debt, and then, making sure you can live, comfortably or below your means for your expenses. And then the rest, instead of keeping in a savings account, just put it in something that you feel is worth your risk for an investment opportunity. Because I would hope that you would see that making your money work for you is just going to help you get some return and then also pay off your debt more and more.
Thank you. I appreciate that.
You're right. You're welcome.
I saw there was a question in the chat, and also Derek, that was a really great question. I'm sure a lot of us were secretly thinking about our student loans in the back of our minds. So that's a really awesome question. Namisha asks here, have you tried art investing?
I have not tried art investing, though I know that that is definitely an asset class. And again, that just speaks to how many asset classes there are and playing to your advantage. So if you're in the art world, you have a specific edge, you have a mentor in the space that can give you the feedback of what is good deal or not. You have art, you have wine. I know there's a shoe marketplace that you can invest in shoes and see that appreciate in value. Know your edge. That's all I can say. Like I'm not in the art world, so I don't, touch that. And I'd rather not FOMO invest to say like, oh my God, everyone's going to the art world, even though I know nothing about it, unless I had a friend or a mentor, an advisor that would support me or hold my hand through it. I just don't think it'd be so much worth it, in my opinion.
Awesome.
Thank you.
You're most welcome.
That's a really great question. I actually myself, Tim, have been looking into art investing. The piece behind me, actually, I'll pan forward because we're part of the new normal here, right, guys?
Amazing.
But this piece I have behind me is from an artist out of Ukraine. So it was one of my priciest purchases I've ever made in my life.
So that's a great example, right?
Besides
Like this,
car,
yeah.
but
So that's an asset that you're just holding on to. You can enjoy it as well as looking at it, and it probably can be more liquid than usual than an angel investment company in an early stage company. And like if you can hold it and hold it for a longer period of time and know that it's appreciating in value, it's the same philosophy application in these other asset classes. So I think you getting started and you having it right in front of your eyes is a beautiful way to learn and keep in reminding yourself and learning that process throughout that as well.
Absolutely, absolutely. And I love what you mentioned about getting a mentor for that, because that's something that I didn't think of. Definitely want to, of course, look into kind of an overarching mentorship with angel investing myself, but didn't think specifically to look for a mentor within the space that I'm looking to dive into. So I think, doing research on any of those asset categories that you mentioned, I think is a really, really good point.
Yeah, and a key adding addition here is that when you do look for a mentor, I always think about like what's in it for them, what can I give them as well. And obviously, one way is to think about is deal flow. So the more you can immerse yourself and just study up, read articles, join communities, and get access to deal flow, you can be like, hey, mentor A, like I would love to learn from you. And you're busy doing this and this. I have some extra time that I'm looking at deal flow. I would love to show them to you, discuss them with you. That's always under your control. And that's a value add. The time that you spend curating the deals is a value add for a mentor that they might even be like, wow, I love this. I want to invest in this. And if they're kind enough, they're going to be like, look, if I'm able to sell this 2, 3, 5 years from now, I'm going to give you a percentage of the profit that I make as well. And that's what I was mentioning. That is always under your control. You can use the advantage of your time and your curiosity to get into deals, even though you might not have any money to put into that right now.
That's a really, really great point. And Namisha mentioned here in the chat that her and her partner are starting whiskey investing, which is awesome. I actually want to make a point here, that people have been talking about the new tequila renaissance, and I have a lot of friends that are part of kind of the beverage industry. And I think something that you mentioned that's a really good point too is if you're feeling a little bit of FOMO, it might be that you're too late. So, when thinking about all these new tequila brands that are popping up, and even these, what is it called? Like the White Claws of the world, I mean, I'm kind of like having a little bit of FOMO myself, but I'm like, I think it's too late. Like, I think it's a little too late.
So one thing I can suggest on that is that I was just watching a video not too long ago, and he was basically saying like the way he thinks about investing is always trying to think it from a contrarian perspective. So like where everyone is at right now, again, doesn't mean it's late. It could mean there's a very strong indication that it might be too late. So thinking about the other side, if everyone was here, what would the other side look like? Study up that other side, and if you have a conviction that the other side will be able to increase in value, that's where you can invest in as well.
Amazing. And then I think we have time for one final question here. Jordan asks, do you have thoughts on investing in turning tangible assets to digital?
Can you give an example of that, Jordan?
Yeah, so I was actually I've actually been doing a lot of reading on investing to figure out, which direction I would like to go. It feels like a better time, even though I do also have those student loans that some student loans I'm sitting on. But I was reading about kind of the direction that people are taking in turning assets that are tangible and making them into almost like a Bitcoin. It gives it a coin and turns it into a digital asset. And that's something that you can now begin investing in. So imagine, then this came to mind when Chelsea was bringing up art, but I know that it's been explored in various other mediums, I'll say, in terms of having your investment become digital, like a cryptocurrency, which you then did that rather than the asset itself.
Yeah, two thoughts about that. One is I haven't explored too much in the crypto world and all of that, so I can't speak on behalf of that. So I think your research is going to be better than me on that. The other perspective I have is like, when I think about turning assets into a digital investment, I think about the examples I've been recently shown, which is a company called Vinovest and I think StockX. But those are owning a percentage of wine bottles that is stored on behalf of you. You don't have to touch any of that issue, and sneakers that you don't have to touch any of that. So if you have an edge or an excitement about those asset classes, in essence, you're not touching any of that process. You're not even holding the actual wine bottle or shoe, and you're just owning, a percentage of ownership in those digital assets, if you want to think about it that way. So it's called Vinovest, and I think StockX.
Yeah, I've definitely been a consumer on StockX in the past. That'll be me living below my means very soon, but but I've been on StockX and that's great.
So maybe I'll end with this, and I know we're wrapping up here, is that I personally think that the best time to invest is yesterday, which means that all of us can step into the investing world. I think what usually stops us is a mindset of either we don't have enough money, or we need more money to get started, or we're not good enough. And so what I really suggest, again, even if you start off with $50, $100, I don't care. Start out with something super small and just start putting money into places, because what I've learned, and I've always applied it in my investing world, even though I was a little nervous at first, was that I'm going to learn the most when my money is at stake. Like, it's just naturally going to happen because we're tied to our money a lot of times. So you got to be careful with having too much emotion in that. I think that's definitely a key point here. But I think as long as you start putting some money, $50, $100, $1,000, whatever it is for you, you're going to naturally start to just be more curious. You're going to start to like lean in a little bit more. You're going to start reading up on things. And that's what I suggest as like the first step. Just put in a small amount into something that you're curious about, or you're interested, or you're aligned with in your investment thesis, and just start learning.
Amazing. Thank you so much, Tim. Thank you so much for the amazing insights. I loved it from the gate. You gave us incredible insights from the very start. I was leaning in, and I'm sure everybody else was. I was teasing you, but just want to note the Yoda behind you. Very wise, very on brand. And so great to see you. Tim and I have worked together in the past, as I mentioned, and he's an incredible investor, entrepreneur, and overall thought leader. So I know he mentioned and shared his email and his LinkedIn, but please feel free to stay in contact with him. And let's continue to keep this community going. But thank you so much, Tim, and thank you all for joining us. And we hope to see you soon.
Thank you for the opportunity, guys.
Thank you. Bye, everyone.